recessions, good for interest rates. When there are more people out of work, a la higher unemployment rate, good for interest rates. So that's a big market mover every single month. And last Friday, it was a very dismal for the economy, very positive for interest rates.
Right. But also we've found that the interest rates go down. And of course we can talk about how we all got here in October of 22 and we can go all the way back. But when interest rates drop in the Northeast, here in our little bubble, prices go up.
Typically speaking. Yeah.
Right.
Yeah. There's definitely an inverse correlation, if you will, because lower rates are more demand pushes price up, and that's, your expertise, of course. So like rates at the moment after, Friday and, yesterday and today, depending on down payment and credit scores and things like that, certainly in the mid sixes at this point. Lower sixes is attainable with, more down payment and
better
credit scores and things like that.
So I think most people, at least from my conversations at parties and just out in the wild, people think that interest rates are directly tied to the Fed rate. That's not true.
Wait. I'm not the only one at parties that talks about mortgage rates.
No, yeah.
No, it's so fun.
Yeah, we're
Cheers.
also fun and engaging with all of that content.
Can you answer that misconception?
That is it's a question I get asked all day, every day, or I unpack the uncertainty of that. So what justifies mortgage rates is the yield on the 10-year Treasury bond. So the lower that yield goes, the greater chance rates will go down. So if the yield goes from 4.3 to 4.29, doesn't mean rates are going to move. It's more of like trends. So 2 or 3 positive days of reducing yield gets more of a likelihood that rates are going to come down. Whereas, unfortunately, all good things in life, it's easier for the worst to happen. So one negative day might push rates up a little bit. So when everyone talks about the Fed and the Fed's going to lower rates, or they should be lowering rates, and it's such a hot topic the last couple of years, really this year, and at the moment it's there's a lot to get into that one. So the Fed is essentially affecting, or not essentially, they are affecting the federal funds rate, which correlates to the prime rate. So the prime rate today is the one that most people will know on the street. Prime rate's currently 7.5%. So if the Fed lowers rates by 0.25%, they lower the federal funds rate, the prime rate will go, and say they lower it by 0.25%, it'll go from 7.5 to 7.25. That does not mean anything will happen with mortgage rates.
Right.
Typically, it will correlate down. It will ultimately, but there are many days when the Fed has lowered rates over the years and mortgage rates go up.
Right.
Try and explain that to people.
Right.
The whole world is like, hey, my rate went down. Like, no, it really didn't.
Right.
It's more of how the markets react to what the Fed says. Rather, in life, we're all taught as little kids, it's, actions, not words, right? Talk is cheap. But when it comes to the Fed, it's what the Fed says, not really what they do.
And that's because of how people react to what they say.
Exactly.
Right. And ultimately, too, historically, we're still at a really good rate. I know that everyone panicked because, I think we're past that point where everybody was really used to that 3 and 4% rate. And everyone's, I think, frankly, my opinion is that we got used to it really fast.
Yeah, we had to.
People complained about it, right? And people had misconceptions about it for a really long time. And I think we're at a place now where everybody recognizes that we're here. We're probably going to stay here